guys, Freaky Finance here. It's been a little bit, been super busy, so I'm trying to get back into this thing, and today's going to be a fun one. It's going to be the first time we're going to talk about preferred shares on the channel, and I know more than 100 videos in, but we're going to talk about preferreds. And preferreds are a fun one, and I was kind of thinking, like, how can I tie in preferreds to an existing idea so that it's like not too long of a video, because I always want to make these short. This one's hopefully shorter. So we're going to pick Enbridge, and if you need to, you can go back to other videos on Enbridge I did in the past, especially earlier on during COVID. This company's done as expected very well, when including the dividend yield. It's been a nice one over the years. And we'll talk to some of the drivers really quick here, and then we'll go into the preferred shares and why I'm looking at it now. I wanted a video that kind of tied into the Bank of Canada interest rate cuts, so that I can go back, I can be like, okay, this is what my thinking was at the time when this happened. Ultimately, it would have been better in October. A lot of things would have been. And maybe we'll get another shot in this October, who knows. For whatever reason, when I'm doing Halloween decorations every October, I'm like, oh my god, look at all these buying opportunities. For the last 3 Octobers, it's been like that. So maybe we'll get it again. Honestly, in the middle of June, there also seems to be softness for whatever reason. And then I pick up some stuff. Anyway, we'll go into Enbridge. So, Enbridge, most people know, is a stable business. The liquids, we talked about the regular. Again, we'll go to the main video for the actual more details on the business model. But so far, it's performing fine. The debt levels within target, and you can see the double-digit adjusted EBITDA growth over in Q1. So the base business is up 8%. Some of this is inorganic, and we're going to talk about the M&A really quick here. But first, the core business, the big business, liquids business. Even after assuming the remaining utilities in the U.S. close that they acquired, they're still about 50%, or really about 50% liquids. The big business, so basically moving oil from a source location to export areas, so basically the Gulf, and now Western Canada, finally. So these LNG terminals here are super important in the long run from my point of view, for other investments as well, because I'm big into natural gas, as specifically LNG for hub hopping. So basically you have a price in Alberta that's crap, you have a price at Henry Hub in the States that's kind of crap, and then you have really dislocated ones, say a Netherlands TTF or a Japanese Korean market, JKM. And this is basically a way to quarterback, like when the prices get dislocated, you already have the storage at the export facility just to ship it over, and you basically get that nice price play. That's how I view it, and I like storage in these areas, and the companies are allocating capital to that idea. A lot of pipelines are, and I like that. I just think that's very clever as we push to renewables, which are still not reliable. So I just think that's smart. So you can see wood fiber here, 60% engineering milestones expected in second half of this year. Ultimately Gulf, a lot of activity there. And we've seen more and more storage pickups along the way. What else I liked lately in 2023? They made some really, in my mind, we'll see how this plays out, but so far what I've been able to understand, the utilities that they picked up were pretty nice, at a pretty nice price. Basically, they took advantage of an over-leveraged utility in the States, and they got some nice prices on it, I think. And I think Enbridge is a company that will do well as interest rates actually start bottoming out itself. And then I'm like, how can I play this on a preferred way and try to lock a higher yield for at least 5 years? So, well, interest rates are still relatively high because they've just started. Bank of Canada just cut rates last week or 2 weeks ago now by a quarter. So here's kind of what I mean. You can see the core business continues to do well. We've seen a lot of volume, record volume actually, on liquids pipelines for Enbridge. So that number, again, is a toll play. I'm not going to go into the details here. We do in the video a while ago, but basically you're making money as volume goes through your pipelines. The gist of it. They do have the transmission and distribution. We talked about that a little bit through the utility side, which is also some of it's inorganic. The main thing, and what was interesting to see over the last 2 years really, is how the market would treat the EBITDA growth, which we would expect, especially because a lot of these ride inflation anyway, versus the increase in interest rate expense. So this is a highly capex business. Pipelines are. It costs a lot of money to make a pipeline. And so a lot of them have to borrow. And so as borrowing costs rose, we saw interest rates go up, and it kind of squeezed. So any of the EBITDA growth that we were seeing was kind of getting offset by the interest rate increase. And now it'll be interesting to see how the continued EBITDA increase will show up against interest rates, which may still slowly increase depending on where they're currently sitting in their current weighted average cost of capital. Really, what's going to be resetting this year for Enbridge versus how much of their debt is floating, so variable rate, as that should actually start coming back down. So it'll be interesting to see if as EBITDA growth keeps stepping up, does interest rate expense flatline, and then we'll start making more money on the spread as well. So not just seeing EBITDA growth, but actually seeing more EPS growth finally, which has kind of been eaten away by the interest rate expense increases. So in terms of the core business, that's kind of exciting to me in terms of if interest rates actually have top ticked for this cycle, as inflation appears to be under control. In Canada, at least. Canada is probably the weakest economy out of the 7 right now. It'll be the G7 rather. It'll be interesting to see how the market treats this, especially the higher dividend yield will probably become more attractive as interest rates start coming back down and people are like, oh, my GIC is resetting and I'm no longer getting 5%, I might only get 4% or heaven forbid 3%, right? It might be like, all right, maybe Enbridge paying whatever it is, 7 or 8%. Isn't so bad, especially if the core business between the disconnect between EBITDA and EPS starts closing with interest rates coming back down. Now, Enbridge didn't have that much floating debt exposure, but the debt levels are so high in terms of absolute dollars that you might actually see some flatlining in the year-over-year interest rate expense growth, while the EBITDA growth just continues chugging along. Because right now you kind of had it where EBITDA growth was growing double digits, but so was financing cost. And it wasn't fully offsetting, obviously, because financing costs a lot lower than EBITDA, but it was eating into the improvement year over year. So we'll have to see how this plays out when that actually comes back the other way. And the EBITDA growth just continues to chug along. Because they've done things that I think are smart in the long run in the last 2 years at Enbridge. So anyway, here's them June 5th cutting the rate for 7/5 versus bank at 5. This is basically, I like the thought leadership at RBC out of the 5 banks. I go through them, and I think this one's usually the best, well written, and it's also timely. So they have a good turnaround time there at RBC. But anyway, you can see here they basically say Canada's been underperforming global peers. We already knew that on a per capita basis. I brought that up a few times on the channel. The unemployment's been rising, and inflation growth has already been between the 1 to 3 range. So we've seen higher rates have a bigger impact on the Canadian economy quicker than other economies. A lot of that ties into housing, and a lot of it because Canadians were already levered up going into the COVID pandemic pretty hard. And you can see this here in the unemployment already going past 6% in Canada versus where they were post-pandemic. Lows, 4.8%. So we've already seen a lot more pressure. We're seeing that in the bank provision cycle as well for provision for future loan losses. We've seen that start increasing higher than 2019 averages, which means that basically the banks have already provisioned for a current economy that's worse than 2019. So most people are agreeing with this. I think that Canada is getting weaker quicker. Well, maybe not quicker, but it's weaker than the other ones on a relative basis. Here is where we're going to jump into preferred shares. So I was like, how can I do preferred shares? And I was like, I'll just take RBCs because it's a good job here. And again, there's a stable source of income, so it's kind of like, we haven't really talked about bonds too much in this channel. Part of it's because I'm younger, and I find in my eyes, I have a better advantage going through stocks and 10Ks than going through the debt issuance, because bonds are really like a contract, and you need to go into that specific contract. So even if you write on the company, it's really, you need to know what's in the contract, and it's very specific. So you need to actually go into that bond issuance and see what the covenants are, see where you are in the credit stack, and in terms of time spent versus return, I just have a better, for that metric, I just do better in equities. And I'm just younger too, so I don't really need the fixed income as much as I'm looking for high growers or high dividends and stuff like that. I'm not afraid to take risks. So again, that's just me. Here, I kind of view bonds as playing defense, equities are playing offense, and alternatives can be anything. And in this specific case, we're talking about preferred shares. And in my eyes, preferred shares are kind of in the middle between equities and bonds in terms of risk. So again, it's going to depend on the company. Usually, preferred shares will have higher yields than bonds. Usually, and this is specific as well, every preferred share issuance, it's almost like a contract as well, it's cumulative. it's not an actual contract, like there's no legal obligation right here, but I kind of view it because there's so many unique things that could go on in one specific issuance. You really need to go into the prospectus of each preferred that you're thinking about buying, which can be a bit of work, but there usually there's certain pages that matter more. And once you look through a few, you're kind of like, okay, I've seen this before. But it does take time like anything else. So if this is due for you guys, just take your time with preferreds. They are fun. They're very unique. So you don't have voting rights usually how you are in the credit structure. So basically, bonds are the best. Obviously, secured bonds, and then preferreds, and then equities in terms of who's getting wiped out first in a bankruptcy. That's just how shortcuts there. Cole's notes of where you are in the capital structure. Preferred shares are pretty interesting. There's really 4 types. We're gonna focus for today. This is not like a lecture, so we're gonna focus on fixed reset or rate resets. Specifically, we're doing rate resets today, and the ones that I've looked at lately, a lot of them have a floating rate conversion one, so you can actually, if you ever wanted to switch from a fixed rate to a floating, you can convert it. But for the purpose of today, all we're doing is considering a 5-year rate reset on an Enbridge one. So if you ever want to look at a source, I find the Canadian Preferred Shares.ca to be really good. And all you're doing here is looking for, all I do is sort by reset rate, and I'm just looking for preferreds that are resetting relatively quickly. Because again, if prices or if interest rates are peaking, I want the ones that are resetting now, or ideally I wanted the ones that are resetting 3 months ago or 6 months ago. And so this is kind of my little sheet, and I'll go through them. We're not going to go through all the preferreds, obviously. A lot of Canadian banks are on here, a lot of pipelines are on here, CPX, and a lot of them are being redeemed because the banks say, I'm not going to pay that high interest rate for 5 years, right? So they're just redeeming it and taking it out at 25. 25 is the par value for a lot of these guys. I think almost all of them that I've looked at. And for the purposes of today, we're going to talk about the Enbridge Series 3 right here, which is resetting on September 1st, 2024. They all do have their own credit rating. We're not going to go into purposes of that today, but just if you guys are familiar with bonds, you know how like there's the AAAs and the A's and the triple B's at the bottom. That's the bottom of investment grade, and then you go into the C's, which are kind of dicey depending on the company. It's a similar idea as a credit rating here. Usually the banks have better credit ratings, and then oil and gas can be interesting. Here's on the website, so if you ever want to go to prospectus, you go to the actual company that issues it, they list all their series. So here I'm looking for Series 3, P.R.Y. It's the ticker, so Enbridge.P.R.Y. You click on that and you can see the prospectus. And they're just 21 pages. Again, the reason why I started with the underlying business, because you do need to understand the underlying business when you're buying preferred. Because at the end of the day, that's what's going to drive the overall performance. Ultimately is different. Since you own the preferred, it's more of a fixed income part strategy. Whereas common stock, you're ultimately riding more volatility. Allegedly. During periods of stress, when people are selling, you're going to see preferred sell off at the same time. And actually that can lead, and what I'm starting to learn as I get older, is that can lead to very good long-term returns. Really, the first page is probably the most important for preferreds because it will tell you really what I want to know. Here, what the fixed rate reset period is, just to make sure that it's correct. So last time it reset was September 1st, 2019, right here. And it says it will reset every 5th year thereafter. So September 1st, 2024, which is coming up in 2.5 months. You can see the spread here is equal to the sum of the Government of Canada yield as defined herein, which we'll go into in a second, on the fixed rate calculation, plus a spread of 2.38. So a spread over the 5-year GOC. Right here, sorry, my thing was in the way. So spread plus 2.38. So we go, okay, what's the Government of Canada? Again, this is where they reference the 5-year. So what you want to do then, what I do anyway, is I go to the Bank of Canada website, and what I do is download CSV, so Excel, all the data for the bonds for the last 20 years. Anyway, that's what you get. You get a whole list of stuff. I highlighted the column that matters, which is the 5-year here for me. So again, we go down, September 1st, 2019. You can see right around here. So the 5-year at that time, again, interest rates are very low. So you're only getting 1.25, really, not even 1.15. So very low spread. So you just basically at that time you would have 1.18 plus 2.38, and that would be your current dividend yield. The reason why, if you were to pull it up right now, you would see, well, it looks like it's paying 5.5. That's because it's currently trading at a discount to par. So its par is at 25, currently trading at 17, so it's trading at a discount to par of about 30%, maybe 32%. So that's why it's a little slightly higher than what this would imply, 1.18 plus 2.38. It's because of that discount that it's currently on. So anyway, we go down, and we know interest rates are higher, right? That's kind of the idea here, is that you have a core business that's actually going to improve as interest rates go down, but at the same time you're buying an instrument that's locking at a higher rate while it's still trading at a discount. So these kind of setups I like. Ultimately would have been better in September. The discount was even higher. And you kind of see that, like with preferreds, for whatever reason, when people sell things, they just sell everything. And people don't understand preferred shares, and all they've seen is they don't really see any capital gains, right? They're like, oh, this thing's trading at a discount. Maybe they owned it at 25, they technically see a big decline, right? So they're just like, I'm just going to sell it, right? And so it can, and there's not a lot of buyers on these things. No one looks at them. It's not very liquid. No one big is going to be in it. So it creates these opportunities for people like me anyway. And I'm starting to come around to preferreds over time, especially during periods of stress, I think. And so I want to be in a position for that as well. So the more I look at these, the more interest, it'll just give me another tool, I think. It'll be fun too. So especially as I get older, I think I'm going to appreciate dividend yield more. But anyway, here you can see the 5 years now at 3.34. You'd be like, well, I thought interest rates were higher. Again, the forward curve is pricing in a slower economy relative to what the current rates are. I mean, maybe I shouldn't word this slower economy. It's pricing in a yield curve that's lower at the 5 years than it's currently at the 1 year. It's an inverted yield curve. So anyway, you can see that play out here. And then so you take the current 5 year, and this assumes here that this rate is going to be relatively close to what will be on September 1st, because that's the actual day that it will reset. But you can see this, and then you take the 2.38 spread, you basically get 5.7. However, if it's currently still trading where it is right now at 17, and this is where I bought it, this is what I was trying to show here, I'm in at 17. I'm trying to add as it pulls off a bit, hopefully. So anyway, if this were to hold up, basically you're getting a 32% discount to par. Well, this thing resets to 5.72, which basically, if it stays at 17, the dividend yield that would show up on the screen would be 7.5. So, which isn't bad, right, for preferred. And so, what I'm thinking, maybe Enbridge won't, because the current dividend yield is only 5.7. And we have seen a lot of preferreds get redeemed lately, because a lot of banks basically say, well, I don't want to pay that high. I don't want to be locked in for 5 years. Not locked in, but have that rate reset higher for 5 years if rates are going to start dropping down, right? So some of them are actually buying the premium out at par at 25. And this thing has a similar structure. Here's just a visual of the chart. I just picked the 3 series, the 2 year, the 5 year, and the 10 year. Again, you can kind of see how the inversion of the yield curve still. And you can also see that rates are higher, so it's kind of nice to snipe a preferred that's resetting over 5 years, especially if we ever get things that are really bad, right? Because I don't have a lot of defense. So if things get really bad, then this preferred is going to be worth a lot more because it's reset up here at the 5 year. I mean, in general economy, obviously something is bad at Enbridge, I'm still going to get smacked. But in terms of general economy, if say they did over tighten, say if unemployment right now has gone from 4.5 to 6.1 already, what if it goes to 7 or 8, right, and get a real recession, and that could still happen. I know people are like, oh, they're tight or loosening already, and it's kind of like, nah, anybody who still had debt that reset in 2019 or 2020, they still got to go through this and get hit on the way up. So even if it's starting to come back down a bit, you can see the delta here. They're still going to get smacked as their debt comes due and their mortgages still have to reset. A lot of them are on 5 year fixed, right? So that still has to play out. So even if rates are starting to come back down, we still actually have a net tightening effect on the Canadian economy at a time when unemployment's already worse than 2019. So this is a way to just play this, take advantage of the current income or the current interest rates at a time when interest rates may, if they over tightened, this is a way to lock in higher rates before a recession, anyway, if that was the thinking process. In my eyes, it's just a way to get higher income on the dividend side for at least 5 years. While the underlying business should continue to improve if interest rates slowly come off. So in this case, I'd win in a hard landing, right? Assuming it resets, it doesn't go down too quickly between now and September, interest rates. And I also win in a soft landing, as the business will just continue to improve over time as rates slowly drift down as what's currently priced into the curve. I think I'll win there as well. So that's just my thoughts. It's kind of a fun vehicle to talk about. It's a little bit convoluted, but here's the redemption feature. So this is them. They can redeem at 25. They have to give you 60 days notice, between 30 to 60. And again, they have to pay at $25. Rates on liquidation. So this is where you sit the capital structure to basically say that you're superior to junior shares, which will be the gist of it here. Though we didn't go into the definitions of any of these things, but that's kind of the crux of it. Cole's notes again, at the capital structure, your bonds or secured bonds, then bonds, and then preferred, and then equities. Is kind of how it would work in a liquidation event, if that were to happen. Not something that I'm thinking about with Enbridge, but it's good to know that too. And then whenever you're in doubt, you can always go to the definition of terms. That's what I like to do, so you can kind of see a dividend rate. I didn't talk about this, but this is dividend, not interest income, so that's important for people that are wealthier. We're not tax locating, so let's say if you RSP, you'd want your fixed income there, your interest income, and with this one, it's actually dividend on the preferred side, still paying, so it pays as a dividend, and it's eligible Canadian dividend, which means that the tax rate is relatively low relative to other sources of income, say like actual working or interest income. Dividend income is actually taxed favorably for Canadian institutions, and this would be under that one based on what I can read here on the prospectus. And then you do have the right to convert to floating if you wanted to. Ultimately, that would have been the play during the inflationary uptick in 2022 from 2021, when we started to see the economy inflation get out of whack, partially because of supply and demand. When the world was shut down and all the spending went to goods, right? We saw all the goods shoot up in price, right? We've seen that kind of mean revert now. So this was probably the play for 2021, because you would have been able to participate on the floating on the rates on the way up, which would have been nice. And now we're thinking the opposite, right? We're thinking peak rates, so we want to lock in at the highest rate that we could, and then as rates slowly drift down, either with priced into the yield curve or if there's an actual recession, and you kind of this dividend yield will be sitting pretty. So at least for 5 years. So that's where my head's at. It's a fun one to look at. Preferreds are very unique. I hope you like the video. It's a little bit different. I know there's not too many videos on YouTube about preferreds. Part of it's because it takes a bit of reading. Each one's unique. It's also not taught about too much in undergrads, except for just saying like what they are, not actually going through them and trying to analyze any of them. But anyway, I'd like to know your thoughts on preferreds, and have a great rest of your weekend.